The looming question: a recession on the 2026 horizon. As we stand on the cusp of a new year, a single, clear question dominates economic conversations. Will the global economy face a recession in 2026? This is not merely an academic exercise for economists and market analysts. The answer holds profound implications for households, businesses, governments worldwide. A recession, technically defined as a significant decline in economic activity, impacts job security, investment returns, and the general sense of financial well-being. People care because a contracting economy touches their ability to provide for their families, to plan for the future, and to maintain their standard of living. It is a question of stability versus uncertainty. The current economic landscape presents a complex and often contradictory picture. Headline data flashes mixed signals that can be difficult to interpret. We see resilient labor markets, corporate earnings, alongside concerns about elevated interest rates and geopolitical tensions. This duality is why the debate is so active. The memory of recent shocks, the pandemic, then the inflationary surge, remains fresh. These events taught us how quickly the economic environment can shift. Understanding the probability of a downturn is less about predicting certainty and more about assessing risks and preparing for multiple outcomes. This question gained traction because of unprecedented policy actions. Central banks worldwide implemented an aggressive, synchronized tightening cycle. Those rate hikes are still working their way through the financial system. Historically, sharp increases in borrowing costs often precede contractions. The worry: the medicine for inflation may have side effects, a significant slowdown, potentially tipping the scales toward a recession in 2026. Navigating this requires a calm, data-driven approach. It's easy to be swayed by daily volatility or alarming headlines. A measured perspective looks at underlying fundamentals, separating signal from noise. The goal is a coherent view based on evidence, not emotion. By examining key metrics, comparing to historical precedents, and weighing risks against strengths, we get a more nuanced view. To begin our analysis, we must turn to the hard data. 3 key numbers provide a foundational view of the economy's health. First, gross domestic product, the broadest measure of output. As of late 2025, growth in many major economies is sluggish. We are not seeing widespread negative prints, but expansion has slowed considerably. Many developed nations are hovering just above zero growth. This slow growth is a vulnerability, leaving less buffer to absorb new shocks. That makes a 2026 contraction more plausible than in a high-growth environment. Second, the unemployment rate. It shows the share of the labor force jobless and actively seeking work. A rapidly rising rate is a reliable and painful recession signal. On this front, the news has been surprisingly and consistently positive. Jobless rates are near historic lows. Job creation has moderated, but mass layoffs have not materialized. Employed people keep earning and spending. A powerful support. Third, inflation and interest rates. Inflation spiked, then receded significantly from its peak. But the legacy is higher rates, kept restrictive to finish the job. When assessing the odds of a 2026 recession, look beyond headline numbers and consider forces that push the economy either way. The primary risk is the lagged effect of high rates. Monetary policy works with long and variable delays. The full impact may not be fully felt yet. As firms refinance at higher rates, and as pandemic-era savings dwindle, business investment could slow, and consumer spending could soften. External shocks can spread quickly in an interconnected world. Supply disruptions could spike energy or food prices, reigniting inflation and complicating policy. The system is more resilient than in 2008, but not immune to stress. A major failure or sudden credit crunch could seize the economy. High debt levels amplify fragility. To gauge the risk of a 2026 recession, history offers perspective. In the 70s and early 80s, central banks induced recessions to break inflation. They raised rates to punishing levels, driving up unemployment and cutting GDP. Today, inflation has fallen without a major spike in joblessness. A possible soft landing. Supply-side healing eased disinflation without crushing demand. We lack the widespread systemic excess seen in 2000 and 2008. But late-cycle resilience can deceive. Transitions from slow growth to contraction can happen suddenly. The scale and speed of tightening are significant. Saying this time is different is risky. So, what is the definitive bottom line? The risk of a recession in 2026 is elevated and real, but not a foregone conclusion. The global economy is walking a tightrope. Opposing forces, rate drag and accumulated debt versus a strong labor market and resilient corporates. Outcomes hinge on how these forces evolve, policy deftness, and shocks, or their absence. The base case is continued slow growth, with a thin margin for error. Watch employment reports, any sustained rise in unemployment or drop in job creation, and tightening credit. Track inflation and central bank guidance. Don't panic, prepare. Build an emergency fund, review debt, avoid new high-interest obligations. Diversify to fit long-term goals. Control what you can. Savings, spending, and debt. As we enter 2026, the indicators show steady stabilization across key metrics. Regional dynamics are balancing out, with inflation pressures moderating, and labor markets adapting. Where risk remains, it's targeted and manageable. Policies are calibrated to support growth without overheating. Looking ahead to 2026, confidence is improving. Businesses and households are positioning for steady progress. We enter the year with reasoned optimism, prepared, resilient, ready.